The MPC remains watchful and will not hesitate to take further action in its future meetings as may be necessary. So, the job is not yet finished.
With this statement, RBI Governor Shaktikanta Das left the door open for the MPC to hike rates in future meetings, even as it pressed the pause button after hiking the repo rate by 250 basis points since May 2022. In fact, Governor Das said that the decision to pause was for this meeting only. With the latest MPC meeting ending on April 6th, the policy rate stood unchanged at 6.5%. However, the rate hikes that kicked off in May last year were preceded by the introduction of a standing deposit facility at 40 basis points higher than the fixed rate reverse repo. Thus, the effective rate hike since April last year has been 290 basis points. The decision to press the pause button was taken unanimously by the rate-setting body. By a 5-to-1 majority, the MPC also decided to remain focused on the withdrawal of accommodation. This was done to ensure that inflation steadily moves towards matching the RBI's target. While support continues to be provided for growth, RBI's mandate is to keep inflation at 4% with a tolerance band of 2 to 6%. In his statement, the RBI governor said that the monetary policy actions taken since May 2022 were still working their way through the system. Hence, the MPC decided to keep the policy rate unchanged to assess the progress made so far. Das added that the MPC would not hesitate to take further action, if warranted, in its future meetings. The pause comes after two of the MPC's 6 members, Ashima Goyal and Jayant Verma, voted against the decision to increase the repo rate by 25 basis points in its February meet. In February, Goyal had said the RBI didn't need to continue raising rates until prices fell because there could be a risk of overshooting the inflation-adjusted real rate, which currently stood at an appropriate level for India at around 1%. The pause in repo rate hikes came as a surprise. While declining marginally from the January print, the retail inflation rate in February still remained above the RBI's upper tolerance limit of 6% for a second consecutive month. As a result, analysts had predicted another rate hike by 25 basis points in the April MPC meeting. So, what do experts think about the timing of the pause in rate hikes?
Given that the central bank has raised interest rates by 250 basis points, and this has been the fastest pace of rate hike in the decade, I would say, they thought it appropriate to assess the impact. And by the way, I think they have, it's not a full stop as yet on the rate cycle. It could be a comma as well. So they have kept all their options open by maintaining the stance.
I think it's a little late. I've been suggesting that the rate hike should have been paused about 50 basis points earlier. But, you know, a lot depends upon what kind of monetary policy you believe in. Mine may be somewhat different from theirs, but I think they've done it too late, but I'm glad they've done it.
The MPC marginally hiked its GDP forecast for FY24 to 6.5% from 6.4% projected earlier, with the third and fourth quarters expected to register slightly higher growth than expected earlier. Governor Das said that economic activity remained resilient and the higher Rabi production would be a positive for the agriculture sector and rural demand. But the slight upward revision came even as both the World Bank and the Asian Development Bank scaled down their projections. For its part, the MPC listed protracted geopolitical tensions and global financial market volatility as risks to its growth outlook. Das said that the risks were evenly balanced.
I frankly don't really think that we should expect anything very much higher than 5.5%. And this is for the whole year that I'm talking about. At some point during the second half of the year, the election cycle is going to kick in. And election cycles in India have always meant a massive increase in expenditures. So the weakness that we've been seeing in consumer sentiments and consumer demand will be at least partially, if not substantially, offset by the election spends. And so the second half is likely to look a lot better. But the first half, I think, will be weak.
Well, our forecast for FY24 is 6% GDP growth, slightly higher in the first half, which lowers down in the second half. And I think the interesting part is that most of the projections are in the range of 6 to 6.5%. And in this age of uncertainty, couple of basis points here and there do not matter. Actually, it's the range that matters.
The MPC slightly lowered its projection of retail price inflation for FY24. Consumer Price Index-based inflation rate is expected to be 5.2% for FY24, compared to 5.3% expected earlier. The MPC said that the impact of the recent unseasonal rains and hailstorms on food prices would have to be watched. It also said that core inflation would remain elevated due to lagged pass-through of input costs. The MPC based its inflation projections on a normal monsoon and an annual average price of the Indian basket of crude oil at $85 per barrel for FY24.
Our assessment is similar. I mean, we expect inflation to be at 5%, but that is based on a very crucial assumption that monsoons will be normal. But there's a big question mark to that because of El Nino likely to play out. The 5% inflation forecast is for the full year. And I think for the first half of the fiscal year, we expect around 5.2%.
The experts Business Standard spoke to have different opinions on India's FY24 growth rate. There's also the RBI governor's warning that we are living in very volatile times. However, the RBI has decoupled from the likes of the US Fed and ECB, which have continued pressing the lever on the rate front. This should bring cheer to India Inc., which was calling for exactly such a decoupling. Whether or not the pause pays off by way of increased private capex remains to be seen.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.